They took their best shot. They waited for the cover of darkness. They raised the margin requirements. They flooded the order book with paper shorts. For 48 hours, they wanted you to believe that the silver bull run was over. They wanted you to believe the crash had arrived. But when the sun rose over London this morning, the smoke cleared, and the bull was still standing. We have just witnessed one of the most significant market signals of the last decade. It wasn't a press conference. It wasn't a Fed announcement. It was the price action itself. The market didn't just recover, it exploded. The massive gap up we are seeing, erasing the losses of the previous sell-off in a single session, is not normal market behavior. It is a scream. It is the sound of a bear trap snapping shut on the fingers of the biggest banks in the world. It is the confirmation that the buy the dip mentality has shifted from retail traders on Reddit to sovereign nations and industrial giants. If you panicked and sold during the drop, I have bad news for you. You were the liquidity they needed. You were the fuel for this rocket. But if you held, if you understood the game, you are watching vindication in real time. In this deep dive, we are going to look at the crime scene. We are going to explain why, for the first time in 40 years, the bank's suppression weapon jammed. The paper price tried to lie to you. The physical market just told the truth. This is the analysis the establishment tries to bury. They don't want you knowing their trap failed. We are racing to 1,000 subscribers to break the shadow ban and keep this intel flowing. Subscribe now. Signal the system. To understand the violence of this rally, you have to understand the trap that preceded it. In financial markets, nothing moves in a straight line. Bull markets are designed to buck you off. What we saw recently, the sharp, sudden drop that terrified everyone, was a classic textbook bear trap. Here's how the mechanism works. The banks know where your stop-loss orders are. They know thousands of retail traders set automatic sell orders just below key psychological levels like $60 or $62. To get liquidity, the banks have to trigger those orders. So they use a catalyst, a margin hike or a scary headline, to push the price down just enough to hit those triggers. Snap. The stops fire. Retail traders sell automatically. The chart paints a scary red candle. This convinces the bears that the trend is broken. They pile in. They short the market. They bet the house that silver is going back to $50. But then the trap closes. Because the banks weren't selling to exit, they were selling to buy. They pushed the price down to generate volume, and then they absorbed it all. They bought the contracts from the panicked retail traders. They bought the shorts from the overconfident bears. And once they filled their bags, they stepped away. Without the artificial selling pressure, natural demand took over like a coiled spring. The price ripped higher. It gapped up overnight. Suddenly, everyone who sold at the bottom is left with cash they don't want. And everyone who shorted at the bottom is underwater. They have to panic buy to cover their losses. Their buying fuels the rally even more. This is exactly what just happened. The drop was fake. The recovery is real. Weak markets bounce like a dead cat. Strong markets bounce like a tennis ball. Silver just bounced like a Super Bowl. We talked previously about the margin nuke, the exchange raising capital requirements to force selling. Historically, this is the ultimate weapon. In 2011, it worked perfectly. They raised margins, and silver collapsed 30% in days. It scared the speculators away for a decade. They tried it again this week. They tried to make it too expensive for you to hold your position. And initially, it looked like it worked. The price dipped. But then something unprecedented happened. The market absorbed the blow. Why? Because the composition of the market has changed fundamentally. In 2011, the market was dominated by weak hands, speculators using 20x leverage who literally could not afford the margin call. When the call came, they had to sell. Today, the market is dominated by strong hands, industrial users, family offices, and sovereign wealth funds. These entities are not gambling. They are hedging supply chains. They are protecting wealth. They have deep pockets. When the exchange said, "You need to put up more cash," These buyers didn't sell. They wired the cash. Nokia is a disastrous signal for the manipulators. It means their pain threshold calculation is wrong. They thought a 50% margin hike would break the back of the bull. Instead, it just annoyed the bull. When a market ignores bad news or regulatory attacks, it is a sign of extreme underlying strength. It means the buyers are not price sensitive. They are volume sensitive. They care more about getting the silver than what the margin requirement is. Foreclosure of the margin nuke to sustain a crash is the all-clear signal for the next leg higher. The banks have fired their silver bullet, and now they are standing there with an empty gun staring at a charging rhino. Roofing is what they don't want you to see. It proves their power is fading. We are fighting the shadow ban to spread this confidence. If you want to join the winning side, subscribe right now. The bear trap was just the setup. The London pivot is the fuel. For 40 years, London has been the suppression capital of the precious metals world. Historically, when the price got too high, London would flood the market with supply. They were the seller of last resort. But today, something changed. London switched sides. When the market opened in the UK, we saw massive, aggressive bid orders. Why? Why are the bullion banks suddenly chasing the price up instead of smashing it down? It isn't because they became silver bugs. It's because of one terrifying metric the public rarely sees: the float. You have to understand the difference between inventory and float. Bearish analysts love to point to the LBMA vaults and say, look, there are still 800 million ounces. There is no shortage. They are technically right about the number, but totally wrong about the meaning. Iceberg. The vast million ounces is a 90%, is spoken for. It is owned by ETFs, sovereign wealth funds, and billionaires who threw away the key. That metal is not for sale. The only metal that matters to the price is the float, the unallocated metal sitting in the dealer pot that can be bought and sold. For years, the float was massive. But over the last 3 years, as India and industrial users bought thousands of tons, they drained the float. So today, when we look at London, the iceberg is still there. But the tip, the float, is gone. It's melted. Why is London panicking? Because of the leasing machine. Banks lend silver to industrial users. But now, the users are consuming the metal, solar panels, batteries, and can't return it. The banks have a hole in their balance sheet. They show silver assets, but the vault is empty. They have to go into the spot market and buy physical bars to replace what was lost. They are short covering on a physical level. This buying is price insensitive. They don't care if it's $63 or $65. They need the metal to balance their books before the regulators notice. Now we have to look at the technicals, because even in a supply shortage, price doesn't go up in a straight line. It moves from battle to battle. And right now, the entire silver market is staring at one specific number: $65. Nesday. We are trading just below it. But $65 isn't just a resistance line on a chart. It is the kill zone for the short sellers. Why is $65 so important? Is it magic? No. It is liability. In the options market, speculators have bought massive amounts of call options at the $65 strike price. These are bets that the price will go up. Here is the problem for the banks who sold those options. If silver stays below $65, they win. The options expire worthless. But if silver crosses $65, the banks are on the hook to deliver millions of ounces at a discount. This creates a phenomenon called a gamma squeeze. As the price gets closer to $65, the bank's computer algorithms get nervous. They force the bank to buy silver futures to hedge their risk. This is called delta hedging. But here's the catch. Their buying pushes the price higher, which makes the algorithm even more nervous. So it buys more futures, which pushes the price even higher. Defended, it is a self-reinforcing feedback loop. It is exactly what happened to GameStop. It is what happened to Tesla. And now, it is waiting to happen to silver. If we break $65 with volume, the market makers flip from being neutral to being forced buyers. They will have to chase the price to $66, $67, $68, just to cover their exposure. Taxation. This is the vacuum effect. Above $65, the air is thin. The resistance disappears because the defenders become the buyers. This is why you will see massive volatility right here. The banks will throw everything they have at this level to prevent the dam from breaking. They will sell paper. They will try to trigger stops. But if the physical demand from London and Asia keeps pushing, the dam will burst. I want to know where you stand on this battle. Are the banks strong enough to hold the line, or is the physical wave too big? Go to the comments and type one word: break, if you think we smash through $65 this week, or hold, if you think they suppress it again. Vote now. Acquitted the US market open. This is the moment of truth. Usually the US Open is where rallies go to die. For years we have seen the pattern. Asia buys, London buys, and then New York opens and smashes the price. It is almost like clockwork, the 10 a.m. smash. But today feels different. Why? Because the American investor is waking up to the same news that panicked London. They are reading about the Samsung battery shortage. They are seeing the China export rumors. And crucially, they are seeing the green chart. Americans are momentum chasers. When they see silver up $1.60 overnight, they don't think, it's too expensive. They think, I'm missing out. FOMO is a powerful drug. We are likely to see a wave of retail buying hit the ETFs, like SLV, at the open. This inflow of cash forces the ETFs to buy metal to match the demand, adding another layer of pressure on top of the London bid. However, there is an adversary, the dollar index, the DXY. The Federal Reserve and the Treasury watch silver closely. Runaway silver looks like runaway inflation. Often, during the US session, you will see a sudden, mysterious rally in the dollar to try and cool off commodities. So, the battle today is the FOMO crowd versus the dollar defense team. Symmetric, there is one more signal you need to watch today: the mining stocks. On Friday, when silver dropped, the miners got hammered. Stocks like First Majestic and Hecla dropped 4 to 5%. Investors treated them like the world was ending. But today, silver is back up. Mathematically, the miners should gap up massively. Here's the opportunity. Miners often lag the physical metal at turning points. Wall Street is slow. They want to make sure the rally is real. This creates a temporary arbitrage opportunity. If silver holds these gains, the mining stocks must catch up. It is basic math. The rubber band between the metal price and the stock price is stretched to the breaking point. Watch the Junior Silver Miners ETF, SILJ. If silver is up 3%, SILJ should be up 6 to 7% because of leverage. If SILJ is only up 2%, that is a mispricing. That is an opportunity. Eventually, the equity traders will panic buy the miners. The catch-up trade can be explosive. This specific trading intel, the miner lag, is what the pros use to front-run retail. The algorithm doesn't prioritize this kind of tactical analysis. We are racing to 1,000 subscribers to prove there is an audience for real trading strategies, not just hype. Subscribe now. Don't miss the signal. We have dissected the trap, the pivot, and the gamma wall. But now, I want to zoom out. It is easy to get lost in the minute-by-minute candles. It is easy to obsess over whether silver is up 2% or 3% today. But the most important signal isn't the percentage gain. It is the structure. The market just told us that $61.50 is the floor. Think about that. A few years ago, $30 was the ceiling. Now, $61.50 is the cheap price that billionaires rush to buy. The entire valuation model has shifted. As we head toward December 31st, we are entering a specific seasonal window that favors the bulls: window dressing. Here is the psychology of a hedge fund manager in late December. If silver is the asset of the year, up massively, and he holds 0 silver, he looks like an idiot. His clients will ask, "Why didn't we own the winner?" He risks getting fired. So, what do? In the last 2 weeks of the year, they panic buy the winners. They buy at any price just so they can show it on their balance sheet on December 31st. They want to be able to say, "Look, we own silver. We were smart." This institutional FOMO creates a powerful tailwind into year-end. Funds that ignored silver at $30 are now forced to buy at $63 just to save face. You, who bought at $25, are watching the smart money chase the price that you set. Finally, remember the Max Payne theory. Markets are cruel. They usually move in the direction that causes the most pain to the most people. Scenario A. Silver crashes back to $50. Who does this hurt? Only the silver bugs. But we are used to pain. We don't sell, we buy more. A crash generates no liquidity for the banks. Scenario B. Silver rips to $75. Who does this hurt? 1. Banks. Short billions. 2. Industry. Need metal for factories. 3. Echo pros. Underweight commodities. 4. The public. Holding cash that is melting. Scenario B causes maximum pain to the establishment. Therefore, according to the laws of market sadism, Scenario B is the most likely outcome. The bear trap on Friday was the final attempt to get you off the train. If you held, you are now the one inflicting the pain, not receiving it. This is the reality of the wealth transfer. The tide has turned from paper to physical. The algorithm tries to hide this max pain reality because it shows the elites are vulnerable. We are racing to hit 1,000 subscribers to break the shadow ban and keep this truth front and center. The bear trap failed. The squeeze is on. Subscribe now. Hold the line. Class dismissed.